Forex trading signals. How to interpret and use them. Forex trading signals are indicators or notifications that provide insights into potential trading opportunities in the Forex market. These signals can be generated by various sources, including technical analysis tools, fundamental analysis, or expert traders. Traders use Forex trading signals to assist in their decision-making process and identify potential entry and exit points for their trades. Understanding how to interpret and use these signals is essential for traders. Let's explore the key aspects of Forex trading signals. Types of Forex trading signals. A. Technical analysis signals. These signals are based on technical indicators and chart patterns. They provide information about price trends, support and resistance levels, momentum, and potential entry or exit points. Common technical indicators used in generating signals include moving averages, RSI or relative strength index, MACD or moving average convergence divergence, and Fibonacci retracement levels. B. Fundamental analysis signals. Fundamental analysis signals are based on economic data, news events, and geopolitical factors that influence currency prices. These signals provide insights into the overall health of economies, interest rate changes, central bank policies, and other fundamental factors that impact currency valuations. Traders often monitor economic calendars and news releases to identify potential trading opportunities. C. Social trading signals. Social trading platforms allow traders to follow and replicate the trades of experienced traders. Social trading signals are generated by successful traders who share their trading strategies and positions with others. Traders can choose to automatically copy these trades or use them as a reference for their own trading decisions. Interpreting Forex trading signals. A. Entry points. Forex trading signals often provide information on potential entry points for trades. This could be indicated by a specific price level, a breakout from a chart pattern, or a technical indicator reaching a certain threshold. Traders should assess this signal in the context of the market conditions, consider additional factors, and use their judgment to determine if the entry point is valid. B. Exit points. Signals may also provide guidance on when to exit a trade. This could be based on reaching a target price, hitting a stop-loss level, or a change in market conditions. Traders should consider the risk-reward ratio and their own trading objectives when deciding on an exit point. C. Confirmation. It's important to validate trading signals with additional analysis and indicators. Traders should consider multiple signals from different sources or use technical analysis tools to confirm the validity of a trading signal. This helps reduce the risk of false signals and increases the probability of successful trades. Using Forex trading signals. A. Incorporate into trading strategy. Forex trading signals should be integrated into a trader's overall trading strategy. Traders should have clear rules and guidelines for when and how to use signals, including risk management techniques and position sizing. B. Risk management. Proper risk management is crucial when using Forex trading signals. Traders should assess the risk-reward ratio of each signal, set appropriate stop-loss levels, and ensure that the potential reward justifies the risk taken. C. Combine with personal analysis. While Forex trading signals can be valuable, they should not be solely relied upon. Traders should combine signals with their own analysis, market knowledge, and understanding of price action to make informed trading decisions. D. Evaluate signal providers. If using signals from external sources, traders should thoroughly evaluate the reliability and track record of the signal provider. It's important to consider factors such as their expertise, transparency, and the methodology used to generate signals. Conclusion. Forex trading signals can be valuable tools for traders, providing insights into potential trading opportunities in the market. By understanding the different types of signals, interpreting them accurately, and incorporating them into a well-defined trading strategy, traders can enhance their decision-making process and increase the probability of successful trades. However, it's important to exercise caution, validate signals with additional analysis, and apply proper risk management techniques to mitigate potential risks.